Yeah, it will be if you move over there more. Turn it on. You're on. You're recording. You're live.
We don't hear you on them.
Microphone.
On the mic.
Hello.
There you go.
It's a tough one. It's a tough one. Folks, my
Louder. No.
Am I ready?
Yep, you're ready.
Okay, go. Folks, we have an exciting speaker for you today. By the way, just so you know, my name is Craig Penn. I want to introduce the EFC class at Skyline. Welcome to Skyline, and it's bizforchrist.com. We have an exciting speaker from royalty. Her name is Amanda de Koning. Okay, that actually means Amanda of the King. So just so you know, she's an awesome bookkeeper. I even have to admit, I'm using her, okay? And so just so you know, as an endorsement, she's awesome. She's great. She understands the material. She can make things look simple that are complex. So with no further ado, drum roll, come on, drum roll. Amanda.
Thank you. I'm gonna put my rock star tag on and hand this guy.
It is.
Rockstar.
See if that works, Robert.
Hello. Okay. All right. Rockstar next time. All right. So I hope everyone is doing good. Welcome to Entrepreneurs for Christ Biz class. And I'm excited to be back again talking about bookkeeping. And basically what we have here is what most people start their bookkeeping endeavor looking like. Where do I begin? Frazzled, stressed, and get lost. So that's where I am. All right. So what is bookkeeping and why is it important? It is really important. And what it is the process of reporting and organizing all your business transactions that happen. This is the primary way to figure out if your business is profitable or not. And it allows your business to identify financial challenges before they hit home or hard, usually. And, you know, earlier rather than later is always better. So it helps identify problem areas in your sales or expenses. If you're spending too much in different areas, having good finances and a good bookkeeping record are what's going to help you. Which saves stress. Even if you file an extension, if you owe taxes, you do need to pay them. A lot of people don't realize that up front, and they file the extension saying, yeah, I got 6 more months. It's like, well, not really.
Did the IRS extend from April 15th?
They did out to May. And sanitizer wipes and hand sanitizer and face masks are all deductible this year. So hopefully you have your receipts and all that good stuff. They're completely tax deductible this year. So, okay. That I don't know that one. Yeah, unfortunately, I don't know that one if it has or not. I don't file taxes. It's a little bit out of my realm, but I do all the tax prep. So I don't follow all of it, but I do try to catch the big announcements. All right, so business accounts. In your bookkeeping system, you have these 5 main accounts. They're your basic types of accounts that you are going to be working with. So in bookkeeping, an account, you usually think of an account as our bank or our savings, or it's attached to a bank account, we usually think. But in bookkeeping, all of our accounts are just a record of our financial transactions that we're making for a certain type of account. It's not just a bank. So I try to teach people to think of their accounts as little sorting buckets. So little buckets that you're going to sort all of your financial data into, basically. Either it's income or expenses, you are going to sort into all these buckets, so to speak. So your first account type is going to be your assets. So this one's very important. No, they're all important, but assets. This is the cash that the business owns. It is anything that the business has acquired, they purchased it, and they own it for their business. So it's going to be accounts receivable, your inventory, all your bank accounts, any vehicles that you actually own, you have paid off, any land, property, all of that. So if you own it, you're not paying a mortgage, rent, anything of that, you own that. That is an asset.
On accounts receivable, if we do a service today, give them an invoice, they pay us in 90 days, can we book that as of today if the service has been completed?
Yeah, you can. So, yeah, that gets a little more into what you're talking about is more of like cash versus accrual basis and when things hit your books. But yeah, if you perform a service today and you invoice, it actually goes on your books as accounts receivable, and you should own that money.
So that's income.
Correct. Oh, it doesn't become income until you receive it. It's an accounts receivable. And then when you receive it, then it's technically income. Okay, so your next one is liabilities. We're all very familiar with these. It's really hard to run a business without them. These are all the items that we owe to people, loans and debts and all that fun stuff. So these are going to be your accounts payable, like I said, your loans, and then credit cards are also going to fall into the liability. Depends on, again, we go kind of back to the cash versus accrual basis accounting, which is a little more in depth, but that times your payroll can go on your liabilities if you're doing as a accrual basis. Income. This is why we're all in business, right? For income. So this is obviously the money that you're bringing into your business. However, your sales, however you're doing your sales, whether it's cash, credit, debit, this is your income, your money earned. Expenses, another one we're all familiar with. They never stop. Money spent by our business for items or services, advertising, your payroll, that would be more of, like I said, a cash accounting system, utilities, our outside contractors that we're paying, all those fees that take to run a business, the softwares, all of that are expenses. Equity is the last one. This is the value of your business remaining after your liabilities are subtracted from your assets. So these are going to be your stocks, your retained earnings, anything that you as an owner have put into the business, so owner investments, or anything you as an owner have taken out of the business, owner draws.
Does shareholder equity fall into that?
Yes, so owner draws, owner investment are going to be the same thing as like a shareholder investment, shareholder draws. If you have more than one person or want to really. All right.
Can you hear me, Carlos? Can you show the slides?
That's
Oh,
there we go.
Okay, well, the chart of accounts. This is going to be the foundation of your accounting system. This should be really the first thing that you're setting up to run your book. And you're going to be in this chart of accounts for the life of your books. You're going to constantly be editing and tweaking and adding items into it. So once you set it up, it's not done. Unless you're done. But that's not why we go in business. So the chart of accounts is going to be a list of all the names and accounts that a company has. And this is going to be all based off of those first 5 account types we talked about. So anything in your chart of accounts is either going to be an asset, a liability, income, expense, or equity. Every chart of accounts is customized to each business's needs. So if you're in a service business, or if you're in retail or manufacturing, you're going to have a much different scope of items that you're working with than the other. Retail versus services are completely different. So everyone's chart of accounts is different, and it's very much customized to your business needs. The accounts that you set up in your chart of accounts are what are going to drive your profit and loss and balance sheet statements. So in talking about this, I'm referring to everything running through basically an accounting system like a QuickBooks or a Quicken or a Peachtree or a Sage or something of that sort. They have ones online, Wave, I believe, and a lot of different free versions that I'm really not familiar with, but my wheel well is very much QuickBooks. So that's kind of when I speak of this is going to drive that. I'm speaking from an accounting software view, which is the best way to run your accounting. All right, so chart of accounts. Okay, so here's just a snapshot of what you would find on your chart of accounts. So we have the 5 categories, your assets, and it will tell you just ideas of what you would put in there. So if you bought office equipment, you bought a new printer, or you bought everyone new desks for the office, it's going to be an asset. Assets are usually things that if you go out of business, you can sell off. Think liquidity, things you can turn into liquid cash. You see those going out of business signs, and they're selling their fixtures and stuff. Those were all assets. They're liquidating their assets. So buildings, machinery, your banks, that's your money. Your petty cash, that's your cash. Like we said, accounts receivable, and then they have stocks in there, which is interesting. Yeah, you own your stocks, but I put it in equity. Liabilities, they have same thing, just different items that give you an idea of what you're going to put under each account when you're setting your stuff up. Equity, most of what you do in your equity is only going to be your draws, so what you take out personally and what you put in personally, your investments. Typically, you're not messing around a lot with equity, or at least you should not be. Income, that one's usually a pretty easy given. And then we have our expenses, which we're all very familiar with. So in the middle, you see this cost of goods, which I have not touched on. It's kind of like the rogue account. He doesn't fall in the 5 basic accounts, but it's kind of its special individualized account. So cost of goods are any raw materials or finished goods that you need to create your product, basically. So food sales, you need to buy the meat and the cheese, a sandwich shop. You have to buy meat and cheese and bread to sell a sandwich. If you don't have meat and cheese and bread, you're not going to make a sandwich.
Why would that be just the cost?
It
Makes sense.
It can. So cost of goods is your easy way of seeing, it puts it at the top, and you'll see it after we do on the profit and loss. So the cost of goods are it's going to say your income, and then it's going to have your cost of goods. It's going to take that expense off, and that's going to get you your net income. So it's just a quick, easy way to see, hey, what did I, instead of all those other expenses, like your office, your rent, your utilities, those are going to be there. That's your overhead. So it's just that quick, it's the way it aligns it. But you can absolutely expense all of it. That's really what it is an expense. So profit and loss statement. So this is the key report in your business. You'll also hear it referred to as an income statement or a statement of operations, depending on who you're talking to. So this is going to summarize all your income and expenses incurred during a specific period of time. So it'll reveal the company's profit and losses, obviously during a set period of time. It allows for analysis of performance for different periods of time. And then you can customize it again. That's all based on the chart of accounts. You customize your profit and loss to meet your business's needs. So if you have multiple avenues of services, you're selling a product, you're consulting, and you have a labor aspect, and you want to see individually how each income bucket is performing, you would set those up as different income items. So instead of just saying, yeah, I have all this income, you want to start looking at, well, how much do I get of consulting income? Should I be consulting, or is that like a waste of my time? Should I just look at my labor, or should I just sell my retail product? So it really gives you an idea of where your value best is.
Customer acquisition, would that be on this sheet?
Customer
Acquisition, how much does it cost bringing a customer?
Oh, yeah, that's where, yeah, you would start looking at, there's certain ways to set that up and do different reportings on that. Yeah, definitely you start to see, you know, how much, yeah, if you're having, you know, like I said, you would start to set it up to look specifically at that. So you're looking at bringing in consulting customers, you're starting to advertise, and you would set that up as a certain line item, so you can see how much you spent, how much we're bringing in. And obviously it shows if your company is performing. So is it profitable or is it not profitable at the moment? The profit and loss statement, I keep referring to a set period of time. So the profit and loss is always generated on a set period of time. There is a start, there is an end date. You can pick any start, any end. You can run a month, 3 months, a year. There's the best one is the comparison. You can compare months, last year, you know, March to this year, March, last year overall to this year overall. So there's the profit and loss is your best way to really play around and see how's my business doing. You run a whole year and you sort it by month. And you start to see, oh, well, April's my busy time. No, it's, you know, October's my slowest month. You can start to see your, you know, where your sales are up and where they're down. And it's a really eye-opening tool. Often business owners don't like the profit and loss because it doesn't show really what they want to see. It shows what actually happened. But when people start, it's true. When people start to use it as a tool, though, for their business, it really helps. It makes you be, you know, strategic, and people that really look at them, and if they don't like them, you can change them. I mean, don't change the numbers, but go out there and change it. Put the sales in, or you know, look at where you're spending and be diligent about it. Use it. If you use it as a tool, it will help you. You know, it's all how you think about it. If you look at it and go, oh, it's scary, and hide it in a folder, it doesn't do you any good. So here's the lovely, just a sample of a profit and loss that you'll see here. Larry's landscaping. I did not set this up. This is the example. And you'll just kind of see how the report is run. They have different incomes. So you'll see that at the very top, he has just generalized income. And then Larry wants to know what is most profitable. So it looks like landscaping services are definitely his thing. That's good. That's in his name. And you'll see all the different things: markup income, retail sales, and service. So that was just kind of an idea of how, if you want to track certain areas of your income side, this is how you do it. There's our lovely cost of goods, which is very generic. Usually I try to be a little more, you know, in depth of what are your cost of goods. So Larry's cost of goods are probably gonna be the, have us cost of goods. But yeah, anything that he's using, maybe he's installing sprinklers and stuff, and the parts that he had the sprinklers and then he installed them. And then the owner is going to, in turn, invoice the owner for the sprinklers bought and his labor. So sprinklers or whatever he had purchased would be your cost of goods. And then your expenses, they have it all broken down here, different items. This one right here. Don't do that ever, please. Also, don't do miscellaneous. Nothing is miscellaneous. Nothing is uncategorized. Everything is something. There's a way to find it.
Hawaii trip. Oh,
Yeah, I'll tell you, if you put miscellaneous on your profit and loss and you turn that in, that's gonna be a flag. It's just, don't miscellaneous. Everything has a thing. And if you don't know, I always create this lovely account called Ask My Accountant. And anything that I've trained my clients, anything that you don't know what it is, put it there. Just put it in, so it's in, and put it as Ask My Accountant. Then you either reach out to a professional and ask, hey, how do I classify these things? Or when you go to get your taxes done, you pull up that account and say, hey, can you help me? You know, but that's really, nothing should be miscellaneous or uncategorized. I will tell you that uncategorized is, that is a QuickBooks online generated account. You cannot delete it, but you can keep expenses out of there. And QuickBooks unfortunately likes to stuff things in there. So just be wary of that. All right. So your balance sheet. Your balance sheet is your next most important report that you're going to be referring to in turning in for taxes. This is going to be the reporting of all your assets, liabilities, equity, the shareholders' equity at any point in the business. This is a cumulative report over time. So the balance sheet is often the tricky report. It starts the day you start your file, your bookkeeping file. Like I said, I'm referring mainly to accounting software. So as say QuickBooks, the day you start your QuickBooks file is the day your your balance sheet starts. Anything you put in those banks, any of those assets, equity or liabilities are going to be on that. So from the day you start it to the day you run that report, it's pulling all of that data. It is used for analysis of what the company owns and owes, and it, as well as the company's long-term investments or debts. The assets must always balance with the liabilities. And then it shows how much the company is actually worth at the end of the day. And okay, just so you can see it, here's an actual view of a sample balance sheet. So you'll see assets are always at the top. You have your cash, your accounts receivable. They have inventory, and then they have prepaid rents. Any of their assets, so they have land, they have building and improvements, they have their furniture and fixtures and general equipment. And then down at the bottom, we have all our liabilities. Their accounts receivable, or sorry, payable, tax payables, all their salaries, wages. They have a loan in their long-term liabilities, and then all their equity at the bottom. The paid-in capitals, that's going to be what the owner originally put in. The retained earnings, which is a fund account that is automatically generated from all the other items that you do behind the scenes. So this, the date says 12/31/2017, and you'll notice that, I guess those numbers aren't too big, but usually those numbers will grow. If I run a report today, give it to an owner, they're going to say, why do I have that much owner draws? I didn't do that much. Well, it starts at where you started at the very beginning. So it's a cumulative running total. So that is, this is always your number from the day you started, everything that's added into that. So every owner draw,
The owner's draw is in the total owner's equity.
that's how they put it. They put it in the, I always line them out on my accounts. I like owner's draws and owner liability.
So that's the money they've taken out.
Sorry, investments. Yeah. They probably have it all lumped in that paid in capital. So they make it an in and out account instead of making like a contra account. So I always line them out separately so you can visually, I'm always about visual. I think everyone should visually see what's going on.
So the total equity owner equity, if the owner drew that money and he used it to buy a computer, he should have separated that and used the computer check instead of his own equity. Because if he draws all the money out, I'll buy this, I'll buy that, he shouldn't have done that.
No, yeah, you don't wanna, you wanna pay, for most of your stuff, you wanna pay it for the business.
Got it.
And your owner draws are, I mean, they come out as your income at the end. So your accountant will look at how much you took out of your business for the year and they will add that as your income. So, yeah, you always want to pay out of your business.
I always thought that equity is stuff that's left into the business. You got paid, and wouldn't that be salaries? Wouldn't that be reflected in
It
salaries?
kind of depends. Were you paid as a salary? Were you paid on payroll? Did you pay taxes? Is it a salary? Or is it a salary or is it a salary?
Consultant.
Right, so there's plenty of like self-employed people, you can pay yourself a salary, you know, it's,
Yeah, but so you're saying that owner's equity could be, have to be the money left in, retained earnings, that's part of the equity, that's money
That's
that's still
part of-
in the business.
correct.
But it's, so theoretically, let's assume everything that goes in comes out, you have zero equity.
Yeah, but how do you take everything that goes in, it doesn't all come out? The retained earnings is, it's kind of a convoluted thing. So it takes from your profit from the year before, or the period before, and then all of your assets, liabilities, and then any equity that's ever been input, and then taken out, and then it accounts for your retained earnings. So it's actually pulling from your profit and loss too, that you don't see in here. There's like, if you were to click in that, it would have all these
Breakdown.
different items that it's pulling from.
You know, I have a question, where does goodwill show up on this?
Like like your charitable contributions
No,
and such.
goodwill.
It's-
Where does goodwill show up? Should it show up as asset? Goodwill.
Goodwill is in, you're performing,
Well,
He has a lot of customers,
right,
and that goodwill has a value.
Does that have a value? Where does it show up on?
I'm not sure.
You had it on your first slide. You had it on your first
I'm
slide.
like,
Keep going.
oh, you meant the actual trip accounts, yeah.
There it is.
Oh, yeah, I'm thinking, yeah,
By the way, goodwill is the expectation of future patronage. Okay, great, sounds great.
okay, okay. I'm
You
like,
know,
what are you
so-
referring to as goodwill? A lot of times, like Goodwill, they'll put their donate, you know, like they get
No,
paid to
no.
the church. That's why,
When we evaluate businesses in my
Okay.
line of work, the people laugh because normally there's a buyout by one spouse. And, you know, the goodwill is assuming that I stay in business and that I'm gonna get future clientele.
right,
But they're saying, well, unless I work, you're not gonna get a future client. You know, there's always like people say, yeah, it's like 80 hours a week that gives you that goodwill.
right,
Just, you know.
okay,
You know, but they say, well, no, that actually is on the balance sheet.
yeah,
And they end up having to buy the other spouse out for goodwill, which is an intangible.
okay.
And so I'm always laughing, you know, it depends whose ox is getting bored. Oh,
Well, that makes sense in that regards, of course. Yeah, you're in a very specific line of
well,
work.
when we see business,
Right,
I see business evaluation and then you know, ARs and what's collectibles, and then you look at the AR.
Right.
I'm gonna discount it 50% because I'm gonna have to make deals to get paid. I mean, most of this stuff.
Right, and yeah, if you're wanting
Then you actually have to
to.
try to get true numbers on all that stuff.
Can you repeat some of the conversation? Because it's hard to hear the audience.
Can you repeat his statement? For the people on Zoom, they want to hear a statement. Yes,
Speak loud.
Well, the question is what is goodwill? You know, and it's on the balance sheet. That's one of the problems. Goodwill is it's an intangible. It's the expectancy of future patronage. And in my line of work, I see when they're doing business evaluation, where one spouse is buying out the other spouse. And of course, the person who's being forced to buy the business, generally the managing spouse, you know, they scoff at it because they say, well, yeah, I'm working 80 hours a week to create a business, and you're forcing me to pay I'm penalized because I work 80 hours a week to create that goodwill. And you know, if I fall sick, there ain't any more goodwill. So it's really interesting. In fact, I just had a client the other day say that to me. He says, it's not fair. So listen to that. I said, you know, what's goodwill? So that was first of all. And how do you quantify it? And there's ways to quantify it. The other thing is when you're looking at these, you know, ARs, what's the value of an AR?
Right.
Well, what do you think you're going to collect? Normally, when you're buying somebody out, you discount, you know, 50%. I mean, anything that's over 30 days discounted probably 80, 50%. So I was looking at that, and I mean, of course, I know enough to just, you know, get dangerous because that's not my cup of tea, but I know enough
Right.
to kind of look where the bodies are buried.
And yeah, like, yeah, here's
Thank you very much.
line of work versus the normal day-to-day. Yeah, so good clarification on goodwill. Usually, I mean, typically when people think goodwill, it's charitable, but you, like I said, yeah, in that line, definitely would be a balance sheet.
Well, you know, I want to add something very interesting. The way they analyze goodwill is that two like-situated doctors, one who gets more business than the other, in simplistic terms, that is actually goodwill. So, you know what I mean?
Yeah.
And
Yeah, that's a really
well,
tricky.
and they say, well, yeah, because he basically has a client flow and a good, you know, good public relationship. So he's
Yeah.
getting more business than somebody like situated. And that's actually goodwill. Very
That's
interesting.
a very unique account.
Yeah.
Maybe you should teach a class on goodwill.
see if there's any questions on Zoom.
Yeah. Oh, okay. What's the?
Ask Kathy. They're
Oh, I can't. There are questions on Zoom? I thought she.
Right now, I didn't see any other question proposed, but I'm glad that you're using the microphone and I can hear you. That's great. The audience, I just wish I could hear some of the conversation. That's all.
Got it.
they're wrapping up.
Okay. All right. So if there are no other questions, I really appreciate everyone coming today and listening in. And if you have any questions, please feel free to reach out. I love teaching and just asking, answering questions and getting people set on the right track. So if that's something you are.
Oh, can I interject? I was thinking about something when you were talking about profit loss and use of space, I believe. I don't know if you went through all that in detail, but if somebody is working for an employer and they have their own home office, this might be a tax question, but can you use part of that office space for tax write-off? Do you know anything about that?
Yes.
Yeah. I don't, but apparently you can. Yeah, that seems a lot more tax law. And especially it's always changing.
And what's
Well, especially.
Yeah.
Yeah, well, and the state very much.
Especially
Yeah.
now.
I know.
It's changed
Yeah.
everything.
Yeah, I would definitely ask an actual tax professional, because I don't file, I don't keep up
Yeah.
on all the nitty gritties. But and especially right now, they're like every day, they're changing stuff to accommodate for last year and all that. So definitely ask your professional and keep an eye out. I'm kind of usually on tell people that procrastinating their taxes, but this year it might be hold off, just because they're constantly still updating their tax law and making things deductible. So if you can and you feel comfortable, I say for once in my life, hold off on your taxes a little bit this year, just so you can benefit from all their last minute changes.
What did you say?
I mean, hey, they're changing and not me.
Hey, listen, give her a big hand, folks. It's awesome. What a presentation. She's awesome. We want to thank Amanda. By the way, again, this is the EFC class, Biz for Price, and we had everything you need to know about accounting. So thank you again. And whether we're not going to have a class next week, but we'll have a class after that. So give yourself a big hand for attending. Yay, yay, God.